Buying a home can be one of the most stressful things in life. The surveys have shown it's like death and taxes and then real estate. And that's not a wrong emotion. You're getting yourself into hundreds of thousands of dollars of debt. And for first-time buyers, if you don't already have massive student loans, most people only have a few $1,000s in debt. So this is a major change. In fact, the average person only has $5,800 in debt outside of home mortgages. The stress or anxiety for a lot of people really comes from the unknown. And today we're going to cover the top 5 buyer mistakes you can make as a home buyer. Now, before we get to the 5, at the time of this video, one of my agents is closing on a home in their own home, and this week they are a nervous wreck. That helps 30 to 40 families each and every year buy or sell homes. So don't feel like you shouldn't have that stress or anxiety. And in fact, I think real estate agents should buy and sell a home themselves every couple of years just to know what you're going through. It's one thing to advise on a situation, and it's a completely different thing to go through it. Second, if you buy a home here in Metro Detroit and you're not happy with it, we've had our love it or leave it guarantee running for 15 years and people have actually used it. Simply put, when you buy a home through myself or one of my agents and you don't like it, you want to make a move within the first 12 months, we will sell it for you, waiving our portion of the commission, provided you use us on the home purchase and are using us on the next purchase as well. And it doesn't take away all the cost, but it does help quite a bit. Let's get on with it. And now I'm going to make this video just a little more hardcore than simply get your pre-approval done. We're going to go deeper than that. Number 1, using your gross income to budget your pre-approval. So when you talk to a lender or real estate agent, they're going to ask you what your gross monthly income is pre-tax. And that's the top number. And then they're going to cut it in half. Let's say 50 or 56% for FHA loans. Take out some other payments, and that's how much of a monthly payment you can afford. Now here's an example. If you make $5K a month gross, then you cut that in half, so it's $2,500. Let's say you have a car payment of $500 and credit card debt of $100 payments per month. Then that number lowers to $1,900 per month. That's actually a lot. That's actually a large payment, especially for a first-time home buyer. And that doesn't leave room for things like retirement savings, kids' college accounts, emergency funds. Now, I'm sorry to say that realtors and loan officers are going to automatically pre-approve you for that max loan amount possible, get you into a home, get their commission checks, and get out of there. One mistake I see a lot of loan officers and a lot of realtors make is when you tell them your income, they will tell you how much home you can afford, $400,000, $500,000, $300,000, $250,000, but not what that payment will be with taxes and insurance until you've looked at a couple of homes and fall in love with this one. Let's look at this another way. So that $5,000 per month isn't really your income or your take-home income. After taxes and insurance, which are not counted, it's really 20 to 35% less. So your actual income is really $3,200 to $4K in this example. And you're gonna be spending 50 or up to 75% of that on just your house, your car, and your minimum credit card debt. That's not even paying the card off in full. That's just minimum credit card debt. That's actually insane. That's how a lot of people get into trouble. The term for it is house poor. And when you overbuy a house and then you live on the brink, not able to save anything. So what do? Before you talk to your lender or realtor that's going to take you straight to the max, do a little introspective thinking. Talk to your partner, your spouse, talk with your parents if you're going into loan as a first-time buyer. Someone you trust and admire financially, or a financial planner. There are several approaches that one can take. I like this one mostly because it's simple, and it's the 28% rule. Take your net income, not your gross, your net after taxes, and use 28% of that. Go up to 35% if it's a great house with new roof, new windows, and low expenses. Closer to 25% for an okay house, so you have room to do improvements and upgrades. So at 35%, that puts the person with 60K in income for this example at $1,400 per month instead of $1,900 per month. That's a whole different house, but a safer house. The last way I like to work with people on their budget, and I have a background in financial planning, but I'm not a financial planner, is to start with what you're paying now. Are you renting? If so, how much are you paying? Is it comfortable, or does the payment stop you from doing the things you want to do? Because if you increase it, something has to go. If you move the budget up $200, $300, $400 more per month than you're paying right now, are you okay not eating out as frequently? Are you okay not going on as many vacations? Here's a finance fact, and then my concern for most Americans right now. 36% of Americans say they cannot currently cover a $400 emergency. And now here's something personal about me. My mother has MS, and about a year ago, I was traveling for work and I was hired to train a brokerage in Florida. She collapsed and she needed surgery immediately. That same day ticket to get home was $450. Fortunately, that was a small expense compared to what can actually happen when a real emergency comes up. If you're finding the info in this video quality, please hit the like button so others can find it and subscribe for when we drop more videos. On to the second one. The second one, which relates to the first, is get your savings together. Now, this actually happens a lot where lenders and realtors are clear as mud on what the total costs are actually gonna be in the frenzy to make a sale. They're salespeople. That's the gig. I get it. A couple of times a year, we're representing a seller and we have to delay closing because the buyer didn't realize the true cost and has to pull funds from a retirement account, borrow from the bank of mom and dad, or like shake the couch cushions. We know there's the down payment and closing costs like an inspection or appraisal. For quick math, down payments can range from 3 to 5 to 20 or so percent, or 100% if you're paying cash, really, then it's 100% down payment. So for a $400,000 home, that's $12,000 on the low end. Now, VA loans are still zero down, just want to put that out there, and I love working with veterans and VA loans, and there are many advantages, and they're actually super easy to do if you have a lender that knows the VA guidelines. I'm getting off topic. Then there are the closing fees. Depending on the state, are 2 to 3%. So let's call that $24,000 at a minimum as ready cash that you've got to have available between your down payment and your closing. But that's just the house fund. Then there's the emergency fund. I advise people to have a minimum 1 month reserve fund so all expenses are covered and that is accessible immediately, and 6 months accessible over 14 days. So that gives you time to sell stock, cash in a bond, and transfer the funds if there's a holiday involved. Will this house stop you from saving and getting to those goals? Will it make you financially insecure? If it does, don't buy the house. Don't buy the house. Seriously. I see time and time again where people put literally everything they have in just to get to a closing, and then a layoff happens or something unexpected, and then they're either stuck selling the home or pulling money from the retirement account that should stay there until, well, retirement. After you buy your home, bear in mind, the lender and the realtor are not going to be there to help you make your payments. They're just going to cash their checks and move on. Third mistake I see is home buyers not having their timelines established. And this is especially true for first-time home buyers because you haven't been through the process before. I see a lot of people kind of treat buying and selling a home like popping through 7-Eleven and grabbing a gallon of milk and some eggs and a house. Let's walk through this a little differently, and I always like to begin with the end in mind. To smoothly buy a home, it is a 4 to 6 month process. And let's get those timelines lined up on the screen here. Now I'm going to walk you through it actually in reverse. Today's January 1st, let's just say. It's a new year, new resolution, new you, all of it. Let's buy a house. My lease is up June 1st. I've got to turn in the keys. Seems like on the surface there's a ton of time, but let's back that out. Planning the timelines will give you a smooth and way less stressful transaction. So starting with the end in mind, you've got to move, so budget a few days for that. So now we're May 25th. Now it's going to be easier to paint or replace carpet or make some changes before getting the furniture in. So you're going to want the keys from the seller by May 10th or May 15th at latest, giving you 10 to 15 days to be able to do those things. Most sellers are buying another home and they need time for that other seller to move and for them to move into that home. So the average for that, average occupancy after closing that sellers need is around 45 days here in Southeast Michigan. Now let's put a pin in this one. It's a great negotiation point to get the price a bit lower by being able to give up a little bit of time. And by pre-planning properly, we can save thousands. So now we're up to April 1st. It takes 20 to 30 days to close on the loan. Loan type dependent, lender dependent, and here, always be flexible on the closing day. That's gonna bring the stress down quite a bit. Now, we're going back to March 1st as far as a target closing day. It could be March 1st, 2nd, 3rd, any of those days. Now, we could, in theory, go out and see homes in one day and find the right one, make an offer and get it accepted the same day. And it actually happens like 15 or 20% of the time. And that's because most people have been looking online extensively at hundreds of homes at this point for like a year or more. But for most people, it's about 30 to 45 days to find the right home. Or maybe we think we found it and we got to back up because of an inspection issues. We no longer want this one. Then we've got enough time to go find another without getting into the danger zone of having to release. So now we got to get out and looking by January 15th. And today's the day that you call 2 to 3 lenders to get a feel for who you want to go with as well. 6 months. So we can compress timelines down closer to 3 months if we need to, but the further we compress those timelines, the more stress it is for everybody involved, yourself the most. And that's without any hiccups. Also at the start, a lot of people I see are at the bubble credit score wise, where they're just right there, a few points away from getting a lower interest rate and therefore, of course, a lower payment. A lot of the time, fixing this can be as simple as paying down credit card debt to get that boost. But if you start too late, it could throw off the whole process or cost you thousands more over the course of years in payments. The fourth mistake is going for that perfect house. And this one's a big one for a couple reasons. My parents have built 2 homes in their lifetime, and both times where the home started at 100%, they picked everything out and did all the things, the home was actually an 80% house or less on the day that they moved in. Even building, the day they walked in, they wished they had pushed this wall over here or adjusted the kitchen layout this way, all of those things. Are there great homes? Yes. Are there amazing homes? Yes. But you gotta be prepared to pay a premium for them in any market, up or down. Usually in any area and price range, there are about a half a dozen homes that come up every week. And then there's 1 or maybe 2 that just are at the top. They are over the top. They are the best ones in the category. These, no matter the market, are gonna command a premium over the ones that may need some minimal work. If you have your reserve set, you can go after tier 2 homes. The ones with great floor plans, but they need carpet, paint, hardwood, maybe a bathroom remodel or maybe even a new kitchen. There can be a drastic difference in the price paid for the ugly duckling that you can grow into a swan, not to mention there's going to be low or no competition. So you're paying for the upgrades one way or another, it may as well just be the ones that you want. Last one is buying a home with equity in mind. From day one of the pandemic to October 1st, 2021, the average home value went up 45%. 45%. Now, you did not need to be a real estate Rain Man to profit huge over the last few years. You don't even need to know or do anything to the house. Just basically buy one and hold it. And now here we are in a more balanced market and things have changed. It is not like that right now. And I've got thoughts on it. I've made videos on what I believe is coming next for the real estate market. This isn't that video, but this one thing I want to caution you on is this is not the last 2 to 3 year stretch where you're going to make crazy equity doing nothing. This is the market where you buy a home and hold onto it for 7 years. The average millennial does, or 13 years, the average Gen Xer does, or be in their homes 18 years plus, the average boomer. So hold on, enjoy it, update it over time, but do buy for your needs, not for profit purposes. My name is Mike Perna. If you found this information helpful, hit the like button so more people find it. Subscribe to the channel to be notified when new videos drop. And if we can help you in any way, there's a Calendly link in the description below. Click on it, book a time to talk to me, or give us a call at the number on the screen. Make it a great day and see you on the next video.